Hey, good morning, everyone. Welcome to the macro snapshot, beginning of the second half of the year for the market. So it's Wednesday, July 1st, 2026, of course. Okay, so let's start looking at a few different markets, see what's going on. We had quite a lot of sort of risk on yesterday in terms of the equity. We had sort of quite positive data, but of course today we have a big central bank panel discussion at Sintra, the ECB's sort of annual conference. That's at 9 o'clock. On a panel we'll get not only, I think, Lagarde and the Macklem from the Bank of Canada and Bailey, but most importantly, Kevin Walsh. We'll speak about that in a second. But really, I think what's happening today, if we look at, let's say, the oil complex, let's just look at oil over here. You can see crude oil. You can see the crude oil is bleeding lower, below the 200-day moving average. And on the WTI contract, you can see that we're getting to a pretty sort of key level here around about that recent low at around about 67.83. That's going to be the next sort of test low for the oil bulls, if there are any sort of still remaining. So the point is that that looks as though it's heading down towards that sort of war gap, which is somewhere down around about $60. You can see just down here. We can also see that Brent, if we go across to the Brent chart, just wait for that to load up. Where's Brent? Where's Brent? Where's Brent? The Brent chart is just loading up. You can see what's interesting is that that's actually closed the gap already. So you can see here that the oil gap from the war, it's actually already below that at about 73. So the point is that the good news is that the oil complex is lower, not necessarily gasoline. Gasoline is still actually sort of okay. If we actually look at the gasoline chart here, you can see here that that's actually not doing too badly. And just while we're at gasoline, you can see here that the war gap would be down at about just over $2 per gallon, and we're way there. So completely different performance here of crude oil compared to gasoline, at least in the US gasoline contracts, which is just down to the 100-day moving average, bounced off there. And we can see here that if we look at the crack, CRAK, the crack oil refiners, they're actually doing quite well. So the crack spread's pretty good, because if you're getting cheaper gasoline, but the gasoline end products you're selling for more, that means that the spread for refiners is doing pretty well. So you can see here that the CRAK, which is the crack ETF, which looks at a basket of sort of refiners, they're actually doing quite well and starting to have a nice little bounce. But just getting back to the energy complex in general, what that's meaning is that in general, oil has come down a lot, and the energy complex is cheaper. So that's disinflationary. Now that should be a positive for the central banks, for the ECB, for the Fed, of course. But the thing is that enough for them? Because really, what the central banks are worried about now is sort of potentially sort of secondary effects. Any of these sort of secondary effects from that oil and energy shock and the food shock we had, are they still sort of filtering through the system? Supply lines, logistics. I mean, the Strait of Hormuz, it's not back to normal. Oil production is not back to normal, and that therefore that there have been some shocks, not only to the headline prices, but also all through sort of the supply chain, the logistics, et cetera, et cetera. So the thing is here that the central banks, in my opinion, don't yet have the all clear to stop the pricing of potential hikes, and certainly not yet easing. And that's really what the market is trying to figure out. And if we just actually look and have a look at a little bit of the price action, we can see that yesterday we're still seeing sort of yields up. So we had a pretty nasty sort of push up. This is the 1-year yield yesterday. You see how that pushed up. But especially, let's say, look at the 2-year very big green candle, looking at the 5-year big green candle, the 10-year yield up, and the 30-year yield up. So we had, quite all across the board, we had sort of yields up yesterday. We also had a strong US dollar. So if you actually just look at what's happening here, is that the market is essentially, just going to show you a little bit, just the price action here on the bonds. So if we look here just at just want to show you, this is from the futures market. This is at the end of the day yesterday. And you can see here, looking from left to right, you see the ZT, ZF, ZN, ZB and UB. So going from the 2-year all the way out to the 30-year here, you can see this was sort of equalized at about 8 a.m. And you can see by the end of the trading day here, the front came off, but also, all across the curve, the ZF, the 5-year came off a lot, by sort of 25, 30 ticks or so. And then even out at the long end, the ZB and the UB coming off a lot. That was also echoed at the extreme front of the curve, which is very sensitive to the Fed's policy. So the SOFR contracts, and you can see here, each tick represents 1 basis point. You can see here, even for September 26, so that's only a couple of months away. That came off a couple of basis points. points. And if you go further out the curve, you see here you had a sort of a bear steepening across the SOFR curve. And you can see that going out to, let's say, March down 3 basis points, going out to June 27, down about 4 basis points, the same for December 27. So what is that telling us? It's telling us that, we had fairly strong data yesterday, and the market, it was interesting, the market reaction, that despite the cooling oil, this is the big picture, despite the cooling oil, the market yesterday also looked at the consumer confidence, which came in a little bit lower than expected. But what we did have was the JOLTS number, which was higher than expected. So the number of job openings was up a lot more than expected. And so the bond market chose to say, hey, yep, we've got lower consumer confidence. Okay, we have lower oil prices, crude oil prices. Okay, but the economic data is coming in strong. Gasoline prices are still strong, and prices paid, the inputs are still pretty strong. So the bond market decided to sell off, which pushing the yields higher. And that's why really the big conundrum which we have to sort of solve at the moment is that despite the sort of the cooling energy prices, the inflation still seems to be sticky, at least in the US. And we also have the general economy, the real economy, doing pretty well. And that's why we're seeing not only in the SOFR curves sort of reluctant to price in easing or less hawkishness. We've sort of had that a little bit after the wash, the wash sort of commentary, but the markets now have gone back into pricing sort of high yields. And the point is that the growth story for the equity market, a lot of that is long duration. So basically saying, hey, there's going to be future growth, future profits. And that needs to be funded, or at least, for that story to continue, it needs yields to remain relatively contained, but we're not exactly getting that. So if we just then look and see what's going on in the market, just while we've got some of the graphs up. If we look here, what the Fed is pricing, we want to see today from Walsh at the Sintra meeting. This is very important, but also just generally the central bankers, but specifically from Walsh. Is he going to sort of reinforce that sort of relatively hawkish message, which he delivered after the FOMC meeting a week ago? He hasn't spoken since then. So really what we want to see is if he says, hey, we're still focused on inflation. Yes, the energy complex overall has come down. Maybe the war in between the US and Iran is sort of winding down in a, albeit a fragmentary and sort of problematic way. And is he going to sort of reinforce that hawkish message, or whether he's going to say, hey, inflation's coming down. It was a bit of a transitory thing. Don't worry. So what we do have, and that's really what the market's going to be focused on. And so if we just look and see what the market's pricing here, we can see that even for the July meeting, which is now at the end of this month, you can see that the market's still pricing in a 1 in 3 possibility of a hike, still 8 basis points out of the 25 potential basis points for a hike or a cut, but basically still pricing in, a small possibility of a hike. I think that's a little overdone, but the market is saying that. And then the further out we go in the year, let's say September, October, December, you can see that starts to ramp up, and we have a full sort of hike priced in by the October meeting. So there's a 104% chance of a hike priced in. And then even if we go out a little bit going into 2027, you can see that by the time we get to late April, we've got, almost 1 3/4 hikes priced in there. So 43 basis points. So basically the market is essentially saying, okay, great, energy prices down, good. That's one good thing. But we need to see maybe the data cooling. We need to see prices paid coming down, et cetera, et cetera. And even if you look over in Europe, you can see here, just looking at Europe, they of course hiked last time out, a bit more aggressive than the Fed. But you can see in Europe that there's still, one full sort of hike is still priced in going into March of 2027. You see here 25 basis points. But even over the next, let's say 3 or 4, 5 months, the market's still pricing in, 70, 80, 90% chance of an extra hike. So that's why it's going to be important today at 9 o'clock when the panel of the central bankers in Sintra, Portugal, starts speaking. We want to see not only what Walsh has to say, but also the others. Now, talking about the data, we did get some data sort of overnight and early this morning. Let's have a quick look at that. What was encouraging in terms of the European perspective is that we had the Eurozone CPI come in. And that came in a little bit softer than expected. So you can see here that last month we peaked out at 3.2, but what we got overnight was 2.8. So that was expected to come in at 3. So it actually came in a little softer than expected on the headline. And then the core number, which had been expected at 2.6, or was it 2.6, that came in at 2.4. So that's good news that the core is coming down in Europe. And maybe that means that some of those sort of pricing pressures are coming down. And therefore, that means that if we look at European pricing, maybe ultimately this is going to prove to be a little bit hawkish or overly sort of conservative and a little bit too hawkish. And that could be a good short in the front end of let's say the German curve, like the Schatz, the 2-year bond, the Schatz, and it may be but on the other hand, it's going to be a bit of a negative for the euro. If we also look at the Challenger job cuts, which came in just like an hour ago or so, basically they're a bit more positive, so less sort of job cuts. That was a little lower than consensus. 46,500 is what came in, so that's positive news, less job cuts than had been expected. So overall, though, what that's telling us is that the economy is pretty strong. So let's just go back and look at a few of the charts here and see what's going on. Where are we? Okay, so just looking at the charts. So yesterday, as we see, it was interesting sort of dynamic yesterday because we saw, as we see here, we saw all the yields going up. And therefore, what does that mean? That means that the US dollar is also remaining pretty strong here. So the US dollar had a little bit of a pause. I mean, is this just going to be a sort of like in technical analysis terms, a bit of sort of a bull flag, a little bit of a consolidation? And are we actually going to go up and test that 102 sort of level? And the thing is, if Walsh remains, is that possible? If Walsh remains hawkish today, if the US data continues to be strong. So we saw that, we had a strong JOLTS number yesterday. We saw that the Challenger job cuts was actually less than expected. So that's a positive. And then today we're expecting from the ADP, the consensus for the weekly payroll number from ADP is about 120,000. If that comes in strong, that's also going to support the idea that the job market is strong. And then, of course, the other thing to keep an eye on at 10 o'clock in terms of the data is going to be the ISM manufacturing PMIs. Now, we saw the flash PMIs last week come in, pretty solidly in the US. What's expected here for the headline number is around about 54, so in expansion territory for the headline number. But really what we want to look at also is at 10 o'clock is the employment subcomponents. That's going to be really what the market wants to see, if this strong sort of employment market data is being confirmed. So the previous was 48.6, slightly in contraction. So let's keep an eye on that. We also want to see what's happening with construction spending. Is this whole narrative of, maybe not only AI data centers, but just construction spending in general, is that consensus is for 0.2, so a little bit of softening compared to last time. So that's also part of the mix. But just getting back to the ISM manufacturing, want to see the forward-looking situation, which is going to be in the new orders. Are the new orders, so what's happening in the future, is that supporting the idea of a robust economy? And then possibly even the most important one in terms of inflation pressure, keep an eye on the manufacturing prices, so the prices paid. Really what we want to see is that, okay, energy prices seem to be coming down, but really what central banks and Kevin Walsh at the Fed wants to see is the evidence or non-evidence of sort of follow-through effects, secondary effects, that that sort of energy shock has gone out into wages, prices paid, input prices. So that's why the prices paid element is going to be very, very important. Now, you see last time very elevated at 82. The consensus here is for 79 or sort of 80-ish. The market really wants to see the Goldilocks. What's going to be the perfect combination? So if you're getting back to stocks here, well, actually, we'll get back to stocks in a second. But really, for the US dollar to remain strong, it's going to have to see increasing evidence of sort of a strong economy. We'll get some of that today, combined, let's say, with a sort of a relatively hawkish Kevin Walsh, who continues to stress the importance of fighting inflation, getting the inflation target down to goal. If that happens, there's no reason why the US dollar cannot continue to strengthen. And we see here that, for example, Eurozone inflation we just saw was a little weaker. So maybe this sort of fall in the euro versus the US dollar, maybe that was in fact just a dead cat bounce, or a seller's remorse coming back to that all important sort of 114 level. And if we start to see that sort of differential blowing out between the performance of the US economy versus the American economy versus the US economy, we could see the euro falling. If we also look, let's say the USD JPY, interesting, yesterday there was a little spike. If I remember, I was trading about 10 o'clock down, but basically the US dollar has broken through this very key level of about 162. And as we trade, we're just starting to go higher and higher. Are we in intervention territory? I mentioned yesterday, maybe if the authorities in Japan wanted to do that, they may wait for Marine Day, public holiday, low liquidity. That's more in the middle of the month, July 16, 17, or maybe even this Friday, where we have Independence Day, of course, in the US. But the reality is that with the fundamentals, it's difficult for the Bank of Japan to intervene because the carry is very it's in favor of the US, and the fundamentals are in favor of the US dollar here. So for sure, can they intervene? Maybe. And we'll get like a spike for a day or two downwards. But as you could see, every time they've done that, boom, and then boom, basically, they tried that in late April, and for a couple of days, okay, it went down, and then straight up again. So this is like a beach ball, trying to keep a beach ball below the water. It keeps on, it's so buoyant, it keeps on coming up, and there are good fundamental reasons for that. So the US dollar is still looking strong. CAD as well, as we're seeing the US economy outperform the Canadian economy, and we're also seeing that sort of the energy complex is down. So neither of those are great for CAD. Also today, in theory, we're going to have sort of revision and about the US, what's it called, the USMCA sort of trade agreement between the US, Mexico, and Canada. And Trump is very much on record as saying that he's not happy with that he wants the terms of that revised. So there's probably going to be a delay to that sort of being sort of penciled in, the USMCA review. And if that's the case, that could be a negative, maybe for Mexico, but also for Canada, less favorable trade terms, more uncertainty. And that could also lead to the US dollar maybe sort of wanting to push even sort of higher, maybe getting up to 142 or so. So, USD CAD looks as though that may have a little more upside. As I say, if all the factors, the constellation of factors remains together. So that's that for the FX. So we have FX, which really is basically saying we have the yields higher in the US, starting to climb again. We have a strong US dollar. And so the point is that, in terms of equities, we had a pretty strong performance yesterday. I just want to look at some of the subcomponents. What is interesting is that we saw the MAG 7s continue to bounce off the 61.8 fib retracement here. So the MAG sort of hyperscaler mega caps are doing very well and pushing higher. They will maybe face a little bit of resistance here, as they get up to, let's say, this sort of 100-day moving average up here, but basically looking pretty good. Semiconductors are up 3%. Yesterday, they were almost back to all-time highs. They also bounced off the 61.8% fib retracement. So they look as though they want to retest. The memory ETF DRAM doing very well. What's also interesting is just the broader sort of software sector. It did sort of poke below the 61.8 fib retracement level, as you see here, but even that had a nice little bounce, starting to run into a bit of overhead resistance at the 50-day, 50% fib retracement, and also the 50 and 100-day EMAs at about 91. But overall, we had a pretty good sort of day yesterday for the technology stocks, but not only technology. What we're also seeing here is that the equal weight, so it's sort of broadening out a little bit. So that's a positive, almost up to highs. So overall, the indices did well yesterday. You can see S&P had a pretty nice day. We can also see that NASDAQ outperformed, had a pretty good day. We also see that the small caps and the Russell also at high. So overall, we do seem to be seeing a broadening in the US equity space. But one of the issues in terms of the hyperscalers is going to be the cost of capital. And keep in mind that a lot of the growth, a lot of the performance in the equity space is by these sort of so-called longer duration stocks, which simply means in simple English means that the market is essentially pricing in future growth, future earnings. And in order to do that, it kind of competes with the cost of capital and yields. And as yields go up, that makes it doesn't mean that it's bearish in any shape or form, but it just means that sort of the optimistic, easy story, the easy growth, the easy gains in the stock market, maybe going to come under a little bit more questioning in terms of the earnings and future growth if the bond yields keep on going up. And just looking at the yields, we saw yesterday that the nominal yields went up, but if we also just have a look here and look at the break-even. So if we look at the break-evens, the inflation expectations actually went up a little bit as well. So the market basically is continuing to look at producer prices and the performance of the real economy. And maybe is that it for the inflation break-evens? Is that sort of peak, or let's say, is that the trough in the valley, the low point of inflation expectations, which is to say that now the market's sort of repriced inflation expectations relatively, it has gone lower over the last few days. Is that sort of it? And the market's saying, okay, that's enough, inflation, we don't think it's coming down more. So what does that mean for real yields, which I've been talking about a lot Well, you can see here that the tips were down, which the tip ETF TIP, which as you can see here, the price down means that the real yields are still rising. So even though the nominal yields went up, and even though inflation expectations went up, the nominal yields went up more than inflation expectations, which means that the real yields also continued to rise. And you can see that real yields, they had a bit of a pause for a day or two, but they're starting to go up again, and they're still certainly at the sort of highest levels, or approximately now over 2% for the real yield. So that's the real cost of money. As you have your nominal sort of yield return and then inflation adjusted, you're still paying over 2%. As a real yield. So the question there, is that going to weigh down on the economy and the stocks? Maybe not for the moment or today, but if Walsh, as I say, comes in at 9 o'clock today and really hammers home the inflation message and really says we're not cutting anytime soon, and that sort of a hike is potentially even live even for the July meetings, what's that going to do? That's going to put upward pressure on the bond yields. It's going to put upward pressure on the US dollar, and maybe the more speculative parts of the stock market just might make it pause a little bit. And of course, what it's not going to be good at, all of this stuff happening, is obviously the precious metals. And you can see here that a gold, let's just put it on spot gold here. You can see spot gold, I mean, it's not collapsing, but it's it's trading sideways consolidation below that longer term 38% fib level, which I've marked at about 4,100 on spot. Just finding it difficult to get any substantial grip here. I mean, it hasn't yet gone to and tested that recent low at 38.85-ish down there, but just finding it difficult to bounce. Similar situation here with silver, also in a sideways consolidation. No surprise to the other precious metals. So if we look over here at platinum, trading heavy on the heavy side, we see palladium trading on the heavy side. Also, copper yesterday had been performing well, and to be honest, it's not at lows or anything. So copper definitely outperforming the precious metals, but all of these to move up, especially the precious, they are going to have to see real yields coming down in a sustained way, and the US dollar sort of flatlining or even weakening a little bit before we get anything there. Okay, guys, I'm going to leave it there for today. That's enough for me. So as I say, key things to be looking out for is the ISM manufacturers, the prices paid, new orders, employment subcomponents, all of that. Also construction spending. I want to see the ADP numbers as well, just to give us another bit of nuance for the employment market, and of course the central bank panel over in Sintra, Portugal at 9 a.m. And especially we want to see if Kevin Walsh continues to hammer home a hawkish message. Just some housekeeping. I will probably do just a little review, a brief review of Walsh's comments later on this afternoon. I will also later on this afternoon, early evening, put out a preview of tomorrow's non-farm payrolls. Of course, that's normally on a Friday, but it's going to be on a Thursday tomorrow, just because we have the Independence Day holiday on Friday in the US. That's going to be available at the Macro Shop. So the Macro Shop on YouTube and on Twitter. We're transitioning over there. Nick, I think as well, is putting out his midweek technical analysis update on the Macro Shop as well. So check out that stuff if you're interested in getting that content. Thanks very much, guys. Have a great day, and I'll be back, as I say, later on this afternoon with some updates. Thank you.